Okay, now we're going to move on to weekly option purchases, and I use what I call Prime Trade Select, and this trade selection process is covered in Chapter 1 of the Weekly Option Manual. And with Prime Trade Select, if it indicates the stock is on a buy signal, we want to take bullish trades, and we purchase stocks and ETFs, purchase call options, and we purchase bullish option spreads. And if Prime Trade Select indicates a sell signal, then we want to take bearish trades for that stock by purchasing put options, bearish option spreads, or bearish ETFs. So Prime Trade Select is our trade selection process for our directional trades, and it's a three-step process. Step 1 is we want to determine the price trend, and we use our trend following systems to do that. Step 2, we want to confirm the price trend, and step 3 is we want to select an entry point. So again, step 1, we use a trend following system to determine the price trend, and the basic concept behind a trend following system is a trend following system, it quantitatively measures the buying and selling pressure of a stock, and it allows you to follow the trend instead of trying to predict the trend. And you're using a system instead of emotional decision making. So I've been using these trend following systems for many years, and I think it's the best overall approach for the average investor to use to try to make money in the markets, is to simply use a trend following system. So this is a daily price chart of this is Apple stock. And these vertical bars here represent the daily price movement of Apple stock. So what we like to do to measure the trend is we like to use moving average lines, specifically exponential moving average lines. And these are plotted on a price chart. Here's another daily price chart of Apple with these vertical lines representing the daily price movement of Apple stock, and this blue line is the 50-day exponential moving average line, and that's plotted along with the price movement of the stock. And the exponential moving average, that's the average price of a stock over a specified period of time, with more weight given to the most recent daily bars. So this is the 50-day exponential moving average line for Apple stock. And the EMA trend following system, the rules are pretty simple. If the 50-day exponential moving average, which is the shorter term moving average, if that's above the 100-day EMA, then the stock is on a buy signal. And if the 50-day EMA is below the 100-day EMA, then the stock is on a sell signal. Pretty simple, and pretty simple concept. Here's a example of a Prime Trade Select buy signal, and we can see right here the 50-day EMA, which is this blue line, crossed above the 100-day EMA. And once it did that, then Apple stock was on a buy signal. And as long as that 50-day EMA remains above the 100-day EMA, then the stock is on a sell signal. So when you use these exponential moving average lines along with the Apple price chart, you can see within just a few seconds whether any stock is a buy or sell. So it gives us a clear picture of the price trend of the stock just by displaying these exponential moving average lines. And as long as that 50 days above the 100-day EMA, then the stock is on a buy. And here's an example of a sell signal. This is for Merck stock, and in this time period, we saw the 50-day EMA, which is this blue line, cross right below the 100-day EMA right here. So as soon as that 50-day crossed below the 100-day, then Merck stock was on a sell signal. And as long as that 50-day remains below the 100-day, then the stock is on a sell signal. So that's the basic concept behind the trend following systems. Because it's a rule-based system, this 50 and 100-day moving average crossover, I was able to do historical testing over a 24-year period or when a stock started trading. And what I did is I calculated the initial cost to purchase 100 shares of each of these stocks in this left column, and when they had their first buy signal. So the total cost to purchase 100 shares of these stocks was $8,204, and over that 24-year period, that $8,200 investment produced a $210,000 profit. So, and the average losing trade was only $150 compared to $210,000 profit. So that indicates to me that the system tends to get you out. If there's a losing trade, it'll get you out before that losing trade turns into a big losing trade, which can really hurt your portfolio. So the idea behind the trend following system is when the trend turns bearish, you exit the stock and save yourself from a large loss. And these exponential moving average lines can be downloaded pretty easily. There's a lot of financial websites that offer this. One I like to use is stockcharts.com, and you simply type in the stock symbol and then under chart attributes you could you select daily and then a 1-year range or a 2-year range, and under overlays you select exponential moving average 50, exponential moving average 100, and then click update, and that'll display the price chart along with the 50 and 100-day EMA. So as I mentioned, I've been using these trend following systems for many years, and I actually started out with a $4,600 trading account. That's all I could gather at the time. And within my first 2 years using these trend following systems, I made over $460,000 in profits, and that was trading options. So these are snapshots of my tax returns those first 2 years. So made over $460,000, even though I started small. And so these trend following systems have been working for a long time. I've also have had 7 first place finishes in the trading competition, and I've also had some second and third place finishes. So I'm not trying to brag, I'm just trying to show you that these trend following systems have a long history of profitability behind them. So on any given day, there could be hundreds of stocks that are on a buy signal. So the challenge becomes, how do I narrow down those? Let's say on one day you're able to pull up these 50 and 100-day price charts, and there's 300 stocks that qualify as a buy. So it's a challenge to narrow that down to the stocks with the best profit potential. So what we do to narrow that list down is we use trend confirmation indicators to confirm the price trend, and these point us in the direction of the best opportunities. And one of the ones I like to use is on balance volume to confirm the price trend. And the on balance volume measures volume flow, and it's just a simple, easy to read line. I'll show you an example of it here in a second. And the volume flow precedes the price movement of a stock, so you want to be watching that volume flow. And the volume flow helps sustain the price trend. So if you have volume behind the price move, then that allows the trend to be sustained. And the way the on-balance volume line is calculated, when a stock closes up for the day, volume is added to the line, and when a stock closes down for the day, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the OBV line. So here's another price chart of Apple, daily price movement here. We can see that the 50-day EMA is above the 100-day EMA. So if we want to confirm this price uptrend, we could look at the OBV line, the on-balance volume line, which is in this lower chart. And the numerical value of the OBV line is not that important. We simply want to see this line trending up. And if we do, then that confirms this price uptrend, because we know there's volume flow behind this price up move, and of course this volume flow helps sustain the price trend. So when we have an upsloping OBV line, volume's heavier on the day that a stock closes up, and volume is lighter on days that a stock is closed down. So that's an indication that the buying pressure is exceeding the selling pressure, and that the volume flow will help sustain that price trend. And another confirmation indicator we use is the new 52-week high list. And that's a list of stocks that made a new 52-week high that day. And I found through experience that these stocks that are making new 52-week highs are in a very powerful uptrend, and they tend to continue that price uptrend. And that when they make that new 52-week high, that again is a good indication or a confirmation of that price trend. So if they're making a new 52-week high, then again that confirms the price uptrend, and that allows us to further narrow down that list of potential buys to the stocks with the best profit potential. So we want to see that upsloping on balance volume line, and we like to see the stock making a series of new 52-week highs. So the stocks that are included in that list, the new 52-week high list, represent the best profit opportunities out there. So you want to focus on these stocks making a new 52-week high. So plain and simple, a stock doesn't make this list unless it's in a very powerful uptrend. So here's another price chart for Apple, and we can see the daily price movement with the vertical lines. We can see the 50-day exponential moving average above the 100-day. So the stock's in a price uptrend. We see the upsloping on balance volume line, and then we can see that the stock is making a series of new 52-week high prices. So that is a further confirmation of this price uptrend. And the new 52-week high list can be easily downloaded from barchart.com, and you just click stocks, and then in the left column here, just click 52-week highs, and it'll display the stocks that day that are making a new 52-week high. So this is a great place to start your trade selection process. So let's look at some recent examples of Prime Trade Select steps 1 and 2, and here's one for Discover Financial Services, and we can see the 50-day EMA crossed above the 100-day EMA right here, and so the stock was on a buy signal. We can see the on-balance volume line is sloping up, and we also see that the stock is making a series of new 52-week highs. So this would qualify as a prime trade select buy. Here's another example. This is for Home Depot. Again, making a series of new 52-week highs, 50-day EMA above the 100-day EMA, and a sloping, the unbalanced volume line sloping up. So that'd be another example of a prime trade select buy. Here's another one. This is for Visa. Again, the stock making a series of new 52-week highs, upsloping unbalanced volume line. Now, the third step in our prime trade select is selecting an entry point, and we use the Keltner channels to select the entry point. And the Keltner channels were originally developed by Chester Keltner and then updated by Linda Raschke in the 1980s. And these Keltner channels are very useful. They can help us time our entry and exit points for a stock or an option. They also provide what I call high probability buy and sell signals, and I'll show you some examples of those. And they can also be used to help select an option strike price, and they allow you to select stocks that have a repetitive and predictive price pattern. So very useful part of our three-step process. And the Keltner channels, there's three channels. There's an upper channel, which is this line right here. There's a middle channel, which is this dotted line, and then the lower channel. And these channels act as an overbought, oversold indicator. And basically, when a stock is trading up above the upper channel, it means the stock's getting overbought and will probably retrace back to the middle or lower channel. And if a stock is trading near the lower channel, then the stock is getting oversold, and the odds are it's going to bounce from this lower channel. So when the stock's trading near the upper channel, it's getting overbought. When the stock's trading near the lower channel, it's getting oversold. So a very useful tool. And the way the Keltner channels are calculated is the upper and lower channels are 2 times the average true range of the past 20 days. And those are drawn at equal distance from the central line, which is this dotted line. And the central line is the 20-day exponential moving average of the stock. So the Keltner channels, they display the 20-day exponential moving average with this dotted line, and then the upper and lower channels are 2 times the average true range of the last 10 days, drawn equidistant from this middle channel. So that's how they're actually calculated. And the idea is when we use this as a timing tool, we want to buy a stock when it's trading near the lower channel, and we don't want to buy a stock that's trading above this upper channel because it's getting overbought. And when a stock gets overbought, the odds are it's going to start retracing because it's becoming overbought. And we want to buy when it's trading near the middle channel or the lower channel, and this can help us time our entry. So again, you don't want to buy when the stock's trading near the upper channel because the odds are it's going to start retracing. And what I did in this chart is, this is a price chart for Apple with the Keltner channels, and right here I'm displaying some actual trades I took for Apple stock using these Keltner channels. And these show my brokerage confirmations, the date that I bought the stock, the number of shares, and the price. And what I did was I took these dates and circled them down here on the price chart with the Keltner channels, and you can see that I bought the stock as it was approaching the middle to lower channel. in each of these cases, each of these circles, you can see the stock trading near the middle or lower channel, and that allowed me to buy the stock and at a low risk entry, because you can see the stock really didn't retrace much once it got down to the oversold condition here. It didn't retrace much, so that allowed me to get 3 really good entry points because the stock simply didn't retrace after I bought it. So it allowed me some low-risk entries, and these were all around the $200 price level for Apple. And one of the other benefits of using these Keltner channels is it allows you to focus in on stocks that have a repetitive and predictive price pattern. So this top chart is a price chart for TJX, and you can see that the price movement's very repetitive, very predictive. You know, when it trades down near the middle channel, it usually trades back up to the upper channel. Here it traded down towards the lower channel and then started trending back up. So very predictive pattern here in the price movement of this stock. So these are the kind of stocks we like to focus on, as opposed to this stock. This is a price chart for Mosaic, and you can see there really is very little predictive or repetitive patterns with the price movement of this stock. So we like to focus on these types of stocks. And here's another price example. This is for Sherwin-Williams, and again, you can see a very predictive, repetitive price chart here compared to FCX, where the stock is all over the place, really no predictive price movement with this stock. So again, we like to focus on these stocks with these repetitive price movements. Here's another example, Disney versus Potash. So that's another useful tool that can be used with these Keltner channels. Here, and now we have what I call high probability signals. They don't occur that often, but when they do, there's usually a very powerful rally after one of these high probability trade signals. And these high probability trade signals occur when the stock is in a price uptrend according to the 50 and 100-day EMA, but it becomes temporarily oversold. And in order for it to qualify as a high probability signal, the stock actually has to close below the lower Keltner channel. And here's an example. This is for Apple, and I bought 50 and 50, and I bought 100 and 100, and this is around the 333 price level. So you can see at this point, I'm not displaying the 50 and 100 day, but Apple was in a price uptrend, but it became oversold right here when the price of the stock actually closed below that lower channel. And when that occurred, I bought the stock, and then that was around the 333 price range, and of course there was a very powerful rally after that high probability signal. So what we're looking for are stocks in a price uptrend, and we're looking for them to become oversold, and then that sets up a low-risk entry, and there's usually a very powerful rally that occurs after that. And the last 5 high-probability signals for Apple produced an average rally of 81%. So here's an example of a high-probability signal right here. We can see there was a strong rally after this high probability signal. Here's another example. This is for Baidu, and Baidu, when I took this snapshot, was in a price uptrend and became oversold right here, actually closed below that lower Keltner channel around the $98 level. So my brokerage confirmation shows I picked up another 200 shares at 98.16 right here. and there was a strong rally after this high probability signal. Here's another example. This is for the NASDAQ ETF. It was in a price uptrend, became oversold, closed below that lower Keltner channel, so I went ahead and bought it right here, and then there was a strong rally right after that high probability signal. Here's another example. This is for the S&P 500 ETF. Became oversold right here, so I bought additional shares. And here's a few more examples. This is for Chevron. We can see became very oversold, actually closed below that lower Keltner channel, and then it went on to rally 45% from this point right here. So that's a pretty big move for a blue chip stock. Here's another example. This is for Caterpillar. There was an 85% rally after this buy signal right here in February. Here's another example. This is for Tesoro Petroleum. Again, became oversold right here and then went on to rally 72% from this point. So these high probability signals, they don't occur that often, but when they do, that's something you want to pay attention to, because they can really set us up for a high probability trade. And the stock usually doesn't retrace much once it closes below that lower Keltner channel. So now we use the Prime Trade Select to select stocks and also call option purchases. And I'm going to shift now and just show you a couple examples of call option purchases that I made using the Prime Trade Select. And this first example was for Microsoft, and we can see the 100-day EMA, or 50-day EMA is above the 100-day EMA, so Microsoft was on a buy signal. We can see it was making a series of new 52-week highs, and we had an upsloping on-balance volume line. So this qualified as a Prime Trade Select buy. So I purchased some call options. This is an example of a weekly call option purchase I made. I bought 5 of the February 18th 30 strike calls at 52 cents on February 14th, and then I closed these out on February 17th at 118. So I had a 126% gain buying these on February 14th, selling them on February 17th. So this is just a brokerage confirmation showing that trade. So I used the Prime Trade Select to select this weekly option trade. Now, this particular trade, the option trade produced 126% return. Now, over the same 4-day time period, the stock increased 3.2%. So the option was leveraged, and it provided 39 to 1 leverage compared to the stock trade over the same period of time. So these weekly options are highly leveraged, and they can result in a pretty good return over a short period of time if you time these right. So here's a graph of what this looks like. The option return is this blue section right here compared to the stock return over the same time period, which is this black section right here. So the leverage can provide high returns for these weekly option purchases. Here's another example. This is for Home Depot. This was on a Prime Trade Select buy. We had the 50-day EMA above the 100-day EMA, making a series of new 52-week highs and upsloping on-balance volume line. So I went ahead and bought 5 of the February 18th weekly calls at 31 cents and sold them at 50 cents for a 61% gain. In this particular week, I had 5 weekly option trades, and for that week, I had an average return here, these 5 trades, of 82%. And now I traded 5 contracts, but if you were to trade just one contract, the average cost was $54 per option. So the total cost, if you were just going to purchase one contract of these 5 options that week, it would have cost $270 to purchase one contract of these 5 options. So these weekly options can be traded in smaller accounts because of the lower cost. Here's another example of a weekly covered call portfolio, and that week I had a 83% average return, and the cost to purchase one contract in this portfolio would have been $236. And this is an example of an option spread order that I actually use to roll over these weekly options. If the option still qualifies under our Prime Trade Select process, then we will elect to roll over that option to the following week. And when we roll over, it allows us to compound our returns, and any profits on the rollover reduces the cost basis and the risk. So here's an example. This was for Microsoft, and I closed out the February 24th calls and sold to close the February 24th and then bought to open the March 2nd. So this is just an example of an actual rollover trade that I made for Microsoft options, and the profit that I got from the February 24th closeout actually paid the cost of the March 2nd option. So I had no risk with this March 2nd purchase because the profits from the rollover of the February 24th actually paid for the March 2nd option. So I had no cost basis for these options. And using this Prime Trade Select, I'm just displaying my actual profit results over the last 4 years. And using it in my stock portfolios, I generated over $1.5 million in profits. Using it in my option portfolios, made over $1.8 million in profits. And this $1.8 million in the option profits, those trades are listed in the weekly option manual, and my stock results are listed in my Sure Thing Profit Secrets book. So just wanted to give you an idea that this Prime Trade Select has been working in real time despite these volatile, non-trending types of markets that we've had over the last several years. So the stocks, 1.5 million in profits, average return was 28.9%, 113 winning trades and no losing trades, and with the options had an average return of 85% and about 91% accuracy. So our Prime Trade Select has been working despite these difficult market conditions. So let's take another look at another strategy. This is for the super stock portfolio, and this is a portfolio of stocks that meet not only our Prime Trade Select criteria, but also meet the fundamental criteria that we established for the super stock portfolio. And when we use this fundamental criteria, that allows us to even locate stocks with the best profit potential out of the stocks that are in a Prime Trade Select buy signal. So what we're doing is we're narrowing down that list further with stocks with the best fundamentals, and that's allowed us to also prosper during these difficult market conditions. And the fundamental characteristics we look for in these super portfolio stocks is that they have little or no correlation to the European economies and European debt. They're not dependent on the price of oil or commodities in a deflationary environment. In other words, we want to stay away from stocks that are dependent on the price of oil or commodities because we're in a deflationary environment worldwide. And we want to look for stocks that have a strong equity, revenue, or retained earnings growth rates in a slow-growing U.S. economy. So the U.S. economy has been very slow-growing, and it may be that way for years. According to the Fed chairman yesterday, he said he looks for very slow growth for the next 3 years. So we could be in this type of slow-growth economy for many years, and so we want to focus on those stocks that have strong growth rates despite the slow-growing overall economy. So doing this fundamental analysis really gives us a leg up on a lot of these stocks. We're picking stocks that are doing well in the current market environment. Not only are they on a prime trade select buy, but they have solid fundamentals. And we also like to buy stocks that pay a dividend, which can act as a floor during market correction. So what we've done is, with the super stock portfolio, is we've added these fundamental criteria to our prime trade select, and that's worked out pretty well for us, and we have been able to select stocks that are doing well in this very slow growth environment that we're in. And we also have a super portfolio spread strategy, and with the spread strategy, we buy super portfolio stocks that are performing well, and then we sell weekly call options on weaker sectors against our super portfolio stocks. So we buy super portfolio stocks, and then we'll sell a call option on an ETF in a weaker sector. So this spread strategy allows you to profit from the best performing stocks and also profit from selling weekly call options in weak sectors. And I'll show you some examples of that. Here's an example for TJX. That's one of our super portfolio stocks. And I have a 37% profit on TJX stock. And what I've been doing is selling call options on ETFs in weak sectors against that TJX stock. And there's a difference between this spread strategy and the covered calls. When you do a covered call, of course, it places a limit on the profit potential of the trade. But with this spread strategy, it doesn't cap your upside potential if the stock moves up in price. So if TJX stock moves up in price, that profit won't be capped if I'm short, let's say, the Brazil ETF. So on the other hand, this carries more risk because these are not covered calls and these are naked options. So this has to be done in a margin account. So it carries more risk than a covered call, but it doesn't place a limit on the profit potential if the stock is moving up in price, like a covered call would. So here's an example. TJX, it's on a prime trade select buy signal, and we also have the fundamental indicators. TJX, it's in a confirmed price uptrend, has little correlation to the European debt crisis. It's not dependent on the price of oil or commodities in a deflationary environment, and it has strong equity and retained earnings growth rates despite the slow-growing U.S. economy, and it pays a dividend. So this not only is on a buy with the prime trade select, but it also has those fundamental characteristics that indicate that this stock will do well in the current market environment. And this just shows my open trade profits for TJX. I have about $61,000 in open trade profits. And what I've been doing is selling ETF call options each week, weekly call options against this TJX stock. So here's an example. This is for EWZ, which is the Brazil ETF, and we can see that's in a price downtrend. We have a downsloping on balance volume line, 50-day EMA below the 100-day EMA. So and this week I sold, the week I took the snapshot, I sold 13 of the 57 strike calls, and I collected $1,347 in cash income after commissions from selling this call option. So the idea is we want TJX stock to continue to increase in price, and there's no cap on that profit. And then if we sell a call option on EWZ and it goes down in price, then we're going to collect a weekly premium and a profit each week on the sale of the call option. So it's a spread strategy to profit on both sides. And again, when I sold the EWZ 57 strike calls, they were at the money calls, so that was all time value, and that, as we saw before, becomes profit at option expiration if you're short. So if I was able to continue selling this weekly time premium, now sometimes I change from different ETFs depending on market conditions, but let's just assume that I was able to collect a similar premium. If you multiply that premium I collected times 52 weeks, you get $70,000 of time value profit over the course of the year, and the cost to buy my shares of stock was $74,000. So that would lead to about a 94% cash-on-cash return, and that doesn't include any profits that I would have on the underlying stock. So even if the stock declined 20%, I would still have a good return with this strategy. So let's talk about now allocating our investment funds, and I've put together some general guidelines for portfolios you could use based on the size of your account. And if you had a $5,000 trading account, you could select 5 stocks from the super stock portfolio and invest $1,000 in each stock. And these stocks in the super stock portfolio are in different industries. So if you pick 5 of those stocks, they're all in different industries, you'd have a diversified portfolio, and you, with a $5,000 account, you could invest roughly $1,000 in each stock. And that would be an allocation based on a $5,000 account. Or you could trade 1 or 2 of the lower cost covered call trades. Now, if you had a $10,000 account, you could select 5 of these super stocks and invest $500 in those 5 stocks, which would take $2,500. Then you could take that remaining $7,500 and you could trade 1 or 2 of the lower cost covered calls. So with a $10,000 account, you could do both of these portfolios. And with a $15,000 account, you could invest $5,000 in the super stock portfolio and invest $10,000 in these lower cost covered call trades. And in a $20,000 account, again, you could invest in these 2 portfolios. You can invest $5,000 in the super stock portfolio and $15,000 in lower cost covered calls. And with a $25,000 account, you could trade these 4 different portfolios. And in a $30,000 account, you could trade all 5 of these portfolios. So these are just suggested guidelines. Each member has a different risk tolerance and a different account size. So these are just kind of general guidelines of the various portfolios you could trade based on the amount of cash in your account. And one last thing I want to mention were these mini options, and they're going to be coming out shortly, and they cover 10 shares of stock instead of 100 shares. So if you do a covered call and you buy 100 shares, let's say of a $50 stock, that covered call is going to cost you $5,000. But with these new mini options, you could do a covered call on 10 shares and it would only cost $500. So this will give us a lot more flexibility based on our portfolio size, because these mini options are 1/10 the cost of the current options. Another example would be if you were to do an option purchase for 10 points, that would cost $1,000, but with these new mini options, it would only cost $100. So something to keep in mind in this portfolio allocation. It won't be long before we'll be able to trade all these portfolios with a very low dollar amount.